More than $1 billion worth of QR shares changed hands in the first 2 hours of trade this morning. Index funds who missed out in the float rushed to get the allocation they needed to keep an even weighting across the market. But that's distorted the price, leaving us none the wiser about the key question of whether QR National is too expensive or not. It also raises another question for investors. Are index managers or active managers the best way to go? Here's Andrew Robertson.
When the ABC spoke to institutional investors about the merits of the QR National float, this was typical of the comments we received.
Anywhere between 16 and 20 times earnings 2 years out for an industrial stock in this market is just too expensive.
But notwithstanding that, index funds which try to replicate the stock market as a whole will be bidding for QR National shares in large quantities. The reason is simple. QR National will be one of the bigger companies listed on the ASX. If Kieran Kelly's opinion is correct, QR National will drag down the earnings of those index funds, while actively managed funds which have a choice would benefit from not investing.
We would think that there are active managers out there who would be pleased that they can actually turn their mind to whether they would want their investors to be invested in QR National.
The QR National institutional book build has once again raised the thorny issue of whether active investing provides better returns than index or passive investing.
Australia and the Australian stock market is not bereft of mediocre businesses. The index is full of very average businesses. So you should, in theory, be able to beat the index just by removing the rubbish.
Which is why funds manager Roger Montgomery is an active investor, but he accepts that actively trying to beat the market is not for everybody.
If you're not interested in analysing companies and you're not interested in becoming conversant with financial statements, then it makes a lot of sense to buy into an index fund, to diversify broadly.
The debate around index funds versus actively managed funds has intensified in the wash-up of the global financial crisis when the earnings of superannuation funds took a hammering. It's put the focus very firmly on the fees charged by active managers, and as a result, an increasing number of financial advisors are putting their clients into index funds because they're cheaper.
If you have a look at the growth in ETFs, which is exchange-traded funds, there has been a big increase in the support for exchange-traded funds. Exchange-traded funds are basically index funds which are listed on the stock exchange.
Asiat David believes the debate around index and actively managed investments is not black and white, and says in many investment strategies there's room for both.
The real issue here is being able to choose the active manager that does have the capabilities and the skills to be able to produce those additional returns above the index to justify the higher fees that they're paying.
Russell Investments' Raywin Williams specialises in after-tax returns from investments, which in itself is a contentious topic in a funds management industry that likes to quote pre-tax returns. She says in the current environment where many people have suffered heavy losses, there may be good tax-based reasons for actively managing a portfolio.